Welcome to the Deep Dive. Today we're diving headfirst into a topic that's, well, it's everywhere, isn't it? Cryptocurrency.
It really is.
For a lot of us, it can still feel like this digital labyrinth, full of jargon and complex ideas. But what if there was a way to sort of cut through that noise?
Yeah, get to the core of it.
Exactly. Grasp its potential and maybe the practical steps to actually engage with it.
Well, that's pretty much our mission in this deep dive. We've taken a whole bunch of insights, really comprehensive stuff, from a seasoned expert's training materials.
Okay.
And these were specifically designed to give you a clear, concise, and hopefully genuinely illuminating overview of the whole crypto landscape.
So like an accelerated guide.
Think of it like that, yeah. Your essential guide to confidently understanding, maybe even navigating the world of digital assets.
Okay, let's unpack this then. To really get cryptocurrency, we need to start with the basics, right? At their heart, they're digital assets. But what really makes them different is that they're decentralized, mostly, built on this thing called blockchain technology.
Right, and it's not just one blockchain either. There are actually many different types, each with its own sort of unique features or purpose.
So if they're just digital bits and bytes, what actually gives them value? It can't just be thin air, surely.
No, definitely not. I mean, one of the biggest drivers is utility. Does this cryptocurrency actually solve a real-world problem? Does it power some valuable tech?
Okay. Usefulness.
Exactly. If a project has a genuine use case, people will want it, they'll want to use it, and that creates demand. It's classic supply and demand, really, just in a digital form.
But it's not just about the tech itself, is it? You could have amazing tech, but if nobody knows...
Oh, 100%. Marketing and having a decent budget for it is absolutely critical. Think about a promising project suddenly getting featured in Forbes or something.
Right, that visibility boost.
That kind of attention can make its popularity explode, and with it, the perceived value and adoption rate.
Okay, so utility marketing. What else?
Scarcity is another big one. A fundamental economic driver. Look at Bitcoin, the classic example.
The 21 million cap.
Precisely. There's a hard limit of 21 million coins ever, and we're already over 19 million mined. So as that available supply gets tighter and it gets harder to mine new ones.
The scarcity pushes the value.
Yeah, it acts as a powerful value propeller. It's kind of like digital gold in that sense.
And then you've got, well, competition, I suppose.
Definitely. If you have, say, a dozen different cryptocurrencies all to do the same thing, maybe they're all payment coins promising speed or low fees.
They're all fighting for the same slice of the pie.
Exactly. They fragment the capital available in that niche. And that direct competition, it really influences how each individual coin gets priced.
Okay, that makes sense. And there's one more big one, right? The regulators.
Oh, absolutely. A huge, often underestimated factor. National, global regulations, they can swing markets like crazy.
We saw that with China banning Bitcoin mining, didn't we?
We certainly did. That news alone caused a huge market crash. Investors panicked, feared wider crackdowns, sold off holdings.
Wow.
It's just a stark reminder that even in this sort of decentralized world, external political, economic forces, they still hold immense power.
So pulling that all together, while they're digital, you can almost think of them a bit like stocks.
In a way, yeah. They're both assets. Their value fluctuates based on utility, supply, demand, external stuff.
But with that unique crypto twist, the blockchain foundation.
Exactly. That decentralized nature gives them a very different character.
Okay, so now we've got the foundational what and why. Let's get practical. How do you actually, buy this stuff and sell it and keep it safe?
Right. The most common way in is through exchanges.
Exchanges, okay.
And you'll mainly hear about two types: centralized exchanges, CEXs, and decentralized exchanges, DXs.
CEXs, like the big names people probably hear about?
Exactly. Like Binance, KuCoin, Bybit. They're run by a single company. They tend to be really user-friendly, almost like using an online bank account, but for crypto.
Integrated wallets, easy buying and selling.
Yeah. High internal liquidity usually makes things smooth. Just keep in mind, for bigger transactions, you'll typically need to verify your identity. KYC, know your customer.
Like opening a bank account, basically.
Pretty much.
And the contrast is DXs. Decentralized.
Right. These run entirely on smart contracts. Think of a smart contract like a super smart vending machine. You put your crypto in, choose what you want.
And it just happens automatically if the rules are met. No middleman.
Exactly. With DXs, your crypto stays in your own external wallet, like MetaMask or Trust Wallet.
Ah, so you hold the keys, literally.
You do. The big appeal is anonymity. No ID checks. But because it's all automated code, Well, they can be less forgiving if you mess up. Maybe a bit more complex for total newcomers.
Uniswap, PancakeSwap,
Yeah.
those are DXs.
Yep, popular examples.
Okay, so you've bought some crypto. Now, where does it live? How do you store it securely?
Good question. You've got different wallet options. Hot wallets are software-based, always online. That includes the wallets built into exchanges.
Convenient for trading often?
Super convenient, yeah. But because they're online, they're less secure for holding large amounts long-term. More exposure.
So for serious long-term holding.
You really want a cold wallet. These are physical hardware devices, like a ledger, for instance.
The little USB stick things?
Kind of, yeah. They keep your crypto completely offline. They might cost you, I don't know, a few hundred Polish zloty, maybe 100, 200 US, somewhere in that range.
But the peace of mind is worth it for big amounts.
Absolutely priceless.
Yeah.
You only connect them briefly when you need to make a transaction. Otherwise, your assets are safe offline.
Okay. And then eventually, maybe you want to sell. How does that work?
Usually the process involves converting your crypto, let's say Bitcoin, into something called a stablecoin first, like USDT, which is pegged to the US dollar.
To stabilize the value before cashing out?
Exactly. Then you exchange that stablecoin for your regular currency, your fiat money, dollars, euros, whatever.
And get it into your bank account. Or even an ATM sometimes.
Yeah, bank transfer is common, and some services are starting to offer ATM withdrawals.
Which brings us, inevitably, to taxes. Always fun.
Yes. The rules vary massively depending on where you live. But, for example, in Poland, the 19% capital gains tax generally applies only when you convert crypto back into fiat.
Oh, interesting. So trading Bitcoin for Ethereum, for example, might not be a taxable event immediately.
Often, no. It's
Yeah.
that final step, crypto to fiat, that triggers the tax in many places. But you absolutely need to check your local regulations.
Definitely consult a professional.
Always.
Yeah.
And a quick heads up, CEXs might have withdrawal limits, especially if you haven't fully verified your account.
Right.
And sometimes, for really small, obscure altcoins, you might have to do an extra hop, convert them to Bitcoin first, then to a stablecoin, then to fiat. It'd be a couple of steps.
Got it. Now, beyond just buying and holding or trading, are there ways to earn income passively with crypto?
Yes, absolutely. One method is mining, which uses proof of work.
That's the one with the powerful computers solving puzzles.
That's the one. You contribute computing power, validate transactions, and get rewarded with new coins. But it needs serious capital investment, deep technical know-how.
And cheap electricity.
Crucially, yes, very cheap electricity. For most individuals, especially somewhere like Poland with high energy costs, it's generally not profitable anymore. GPU costs are high too.
So what's more accessible for the average person?
Staking is much more practical for most. It works on proof of stake.
Okay, staking. How does that work?
Think of it like putting your money in a high-yield savings account, but with crypto. You lock up your holdings for a period.
To help secure the network.
Essentially, yes. And in return, you earn rewards, often in the form of more coins. Returns can vary, maybe 2% to 15% annually, sometimes more, sometimes less.
Can you stake different things?
Yeah, you can stake stable coins that usually offers lower but more predictable returns. Or you can stake altcoins for potentially higher percentage gains.
But with the risk that the altcoin's price could drop?
Exactly. Higher potential reward, higher risk. Platforms like Capital.com or Swissborg make staking pretty straightforward.
Okay, that's really interesting. Now, let's pivot to something absolutely vital. Safe investing principles.
Yeah.
Because this market, well, it moves fast.
It really does. And it's remarkably easy to lose money, often just simple errors or worse, emotional decisions. You need a cautious, deliberate approach.
So what's the core advice here?
A huge point from the expert materials is financial preparedness. Before you even think about putting money into crypto, you need a solid financial safety net. Emergency fund, essentials covered.
Don't invest the rent money.
Absolutely not. They specifically warn against using funds meant for groceries, insurance, daily needs. Why? Because if that money is tied to your survival,
You'll panic sell when the market dips.
exactly, you become emotionally compromised, you make bad decisions out of fear, you need detachment from your core financial stability.
That's a really crucial distinction. And linked to that, I imagine learning is key.
Oh, massively. Continuous learning. The crypto space changes incredibly fast. You have to be a perpetual student. Explore different sources, not just one YouTube channel or Twitter account.
If you stop learning, you fall behind.
Pretty much, yeah. You risk making outdated decisions.
And what about the risk itself? Accepting it.
You absolutely must understand that losses are part of the game in crypto. It's not if you'll have a losing trade, It's when.
So have a plan B?
Have a plan B and the golden rule. Never, ever invest more than you can genuinely afford to lose. If losing that amount would seriously impact your life, you invested too much. Simple as that.
Right, don't overextend. And to manage that risk, diversification.
Yes, strategic diversification is your best friend. Spread your investments across different cryptos.
Not just crypto either,
Right.
maybe other assets too.
Ideally, yes. Real estate, gold, stocks, foreign currencies. Whatever fits your broader strategy. Diversification acts like a shock absorber. If one thing crashes, hopefully others hold up. Don't put all your digital eggs in one basket.
Okay. And perhaps the hardest one, emotions.
The hardest but maybe the most important. Emotional discipline. You have to learn to detach your feelings from investment decisions, especially with altcoins, which can swing wildly.
The expert called the ideal investor calm water.
Yeah, I like that analogy. Unaffected by the market's storms or your own anxieties. Mastering this stops you from making impulsive, fear-based, or greed-driven trades that almost always lose money.
The market's a roller coaster, but your mind shouldn't be. Okay, so with those safety principles down, let's talk strategies. Long-term versus short-term.
Right. Let's start with long-term investing. If your goal is significant profit over several years, say 3, 5, maybe 8 years, this is likely for you.
What's the approach here?
It focuses on fundamental analysis. That means deep research. You really dig into a project's white paper, that's its blueprint.
Scrutinize the team, the tech.
Exactly. Check the team's background, their track record, and crucially, understand the real-world problem it's trying to solve. Is it genuine? Does it have lasting potential?
So it's about conviction based on research, not just hype.
Precisely. For beginners who are willing to do the homework, this long-term approach is highly recommended. It's less about timing the dips and peaks perfectly.
Okay. Now for the other side of the coin, short-term trading, day trading.
Yeah, the faster pace. The goal here is to capitalize on quick price swings, daily, hourly, sometimes even minute by minute. It's definitely higher octane.
What drives this kind of trading?
It leans heavily on technical analysis, studying price charts, patterns, indicators to predict short-term moves.
And news or events too.
Big time. Playing on events or news. Think changes in central bank interest rates like the Fed, or major crypto updates like an Ethereum upgrade, or Bitcoin having events that cut supply. Traders try to get ahead of these catalysts.
And there are specific tools for this. Leverage, stop losses.
Right. Leverage lets you trade with borrowed money to amplify potential gains, but also losses. So it's extremely high risk, definitely for advanced users.
Not for the faint of heart.
Not at all. Then you have stop losses to automatically limit your downside if a trade goes against you, and take profits to lock in gains when a target is hit. Essential risk management tools.
If someone's just starting with short-term trading, where should they focus?
It's generally advised to stick to the larger, more established cryptos first. Bitcoin, Ethereum, often called base layer coins.
Why them?
Their prices tend to be influenced more by broader macroeconomic factors, which can make their movements, well, slightly more predictable than the really small, volatile altcoins. Still risky, but maybe less chaotic.
And managing risk in day trading. Losses are expected, right?
Absolutely inevitable. The goal isn't to win every trade. It's about having your winners outweigh your losers over time. Even a 54% win rate over 100 trades makes you profitable.
So protect your capital.
Critically, limit how much you put on any single trade. Maybe 1–2% of your total portfolio, max. That way, one bad trade doesn't wipe you out.
We also hear about long and short positions. What's the difference?
Going long is the simple one. You're betting the price will go up. Your risk is capped at what you invested, but your potential gain is theoretically unlimited.
And short.
Going short means you're betting the price will go down. It's more complex. You borrow the asset, sell it immediately, hope the price drops, then buy it back cheaper to return it, pocketing the difference.
Sounds risky.
It is. Theoretically, your risk is unlimited if the price skyrockets instead. Though exchanges usually have mechanisms to limit your losses to the capital you have on the platform, still high risk.
Okay. One more strategy often mentioned, especially for beginners, DCA.
Yes. Dollar cost averaging. Brilliant strategy.
Yeah.
Very beginner friendly.
How does it work?
You simply invest a fixed amount of money into an asset regularly, say $50 every week, regardless of the price.
Like an automatic savings plan for crypto?
Exactly. It averages out your purchase price over time. You buy more when the price is low, less when it's high. It takes the stress out of trying to time the market perfectly and reduces the risk of buying everything at a peak.
Simple, but effective. Okay, so we have strategies, but how do you actually spot potential? How do you evaluate a project, especially maybe the smaller, higher risk, higher reward ones, the degen plays as they're sometimes called?
Right. Evaluating projects, especially the less established ones, requires serious diligence. First step,
Mhm.
a rigorous credibility check.
Meaning?
Dive into the website. Verify the team. Are they real people? Check their LinkedIn, their past projects, their activity on GitHub if it's a tech project. Confirm any partnerships they claim.
And look beyond their own marketing.
Absolute. Scour independent forums, Reddit threads, Discord chats for unfiltered opinions. You need to be aware that the market, especially for new projects, is full of scams, rug pulls.
Where the developers just disappear with the money.
Exactly. And shillers, people paid to promote projects regardless of quality.
Yeah.
Your due diligence is your shield against this stuff. Maximize your protection.
So the white paper is key here.
It's the project's Bible, essentially. You must read it to understand its core assumptions, the problem it's actually trying to solve, how it plans to make money, and what the benefits are for investors like you. Don't just skim it.
And digging into the team again.
Super critical. What's their experience? Do they have a track record of delivering successful projects? Are they actually experts in the tech they claim to be using? Verify, verify, verify.
Then there's tokenomics. Sounds fancy.
It's just token plus economics. It's about understanding the token itself. What's its purpose within the project's ecosystem? How is it distributed? Private sales, airdrops.
And how the supply changes. Inflation, deflation.
Crucially, yes. Analyze its inflation or deflation model. A deflationary token, where the supply decreases over time, maybe through burning.
Like taking coins out of circulation.
Right. That can increase value due to scarcity. An inflationary token, where new tokens are constantly created. Well, without constant demand growth, its value can get diluted. Generally, deflationary is preferred by investors.
Okay, that makes sense. So that's evaluating individual projects. What about spotting broader market trends?
That's key too. The crypto market isn't just one thing. It's broken down into like over 180 sectors on CoinMarketCap, and it's always changing. The trick is identifying the NERT, the prevailing theme, the next big wave.
Can we learn from past trends?
Absolutely. History is a great teacher here. Think back. Ethereum introducing smart contracts basically created a new digital economy.
Then DeFi exploded, decentralized finance.
Right. And everyone started tracking total value locked, TVL, then NFTs, non-fungible tokens hit the mainstream with things like CryptoPunks.
Then GameFi, playing games to earn crypto. And the metaverse hype.
Exactly. These were major shifts, not just small bumps. They tell you how the space evolves.
So what's emerging now? What trends should people be watching?
Well, one really interesting area is zero-knowledge cryptography, or ZK proofs.
Sounds complex.
The concept is powerful. It lets one party prove they know something or have something without revealing the underlying information. Massively boosts privacy and security.
Like proving you have enough money for a deal without showing your bank balance.
Exactly like that. An algorithm just confirms it. Huge potential in business and beyond.
What else?
Secure data storage is another big one. As Web3 develops, we need better, decentralized ways to store data safely. Projects like Filecoin, Flux, Arweave, Stratus Network, they're tackling this fundamental need.
And Web3 itself.
Yeah, Web3 is the broader trend towards a more decentralized internet, where you, the user, participate more actively creating, editing, voting, maybe even owning parts of the platforms you use. So like a big philosophical shift.
Then we have meme coins, the wild side.
Definitely. Often driven purely by hype, community buzz, speculation, usually no real utility. Arbdoja AI on Arbitrum was an example.
Super volatile.
Incredibly. You need to get in and out fast if you're trading them. Some people use a moonbag approach, take profits, but leave a tiny amount just in case it goes absolutely crazy against all odds. Very high risk.
Good to know. Is there an advantage to getting into these trends early?
Huge advantage. The first mover advantage. Projects that pioneer a new trend often grab the most attention and value.
So don't chase trends that are already everywhere.
Generally, no. The expert advice is, avoid investing heavily in trends that have clearly already peaked. Look for the quiet ones, the emerging themes that are just starting to bubble up. That's where the bigger potential often lies.
This brings us to market sentiment, maybe. Gauging the mood.
Exactly. Sentiment analysis. It's about trying to forecast market moves based on collective emotion, what people are saying online.
Are there tools for that?
Yeah, there are web scraping tools. Things like long short signal, Sandman, Chartdex. They analyze social media, news, forums.
To get a feel for whether the crowd is bullish or bearish.
Precisely. It's like taking the emotional pulse of the market. Can provide useful context.
Okay, this is a lot of great info on what to look for, but where do people go to find reliable information in this, often confusing space?
Good question. For basic data aggregation, CoinMarketCap is the classic. Oldest, biggest, great for general market cap info, checking new projects, ideal for beginners.
And CoinGecko.
Second biggest. It differentiates itself a bit by focusing more on community stats, developer activity, gives you a slightly different angle on project health.
What if you want to get more specific, like into DeFi data?
The Messari is excellent. It's geared towards more advanced analysis, offering really well-categorized data for specific sectors. Great for deep dives.
Okay. What about news sources?
For reputable crypto news and analysis, CoinDesk and Cointelegraph are probably the top two. They cover market moves, but also the bigger picture, regulation, economic impact.
It provides context.
Exactly. And don't forget broader financial literacy. A site like Investopedia is invaluable. It covers general finance and economics, which really helps you understand the crypto market better.
Okay, now, I've heard about on-chain analysis. Sounds like looking under the hood.
That's a great way to put it. On-chain analysis tools let you track public blockchain transactions directly. You get deep insights you can't see on a normal price chart.
Who's the leader there?
Glassnode is widely considered top tier. They offer a huge array of indicators.
Like what?
Things like hash ribbons for mining health, MVRV ratio for market valuation, supply and profit loss to see holder sentiment. You can even track whale addresses, see what the biggest players are doing. Are they buying, selling?
Wow, that's powerful. Is it expensive?
They have different tiers. Free basic data, but the really advanced stuff used by pro traders requires paid subscriptions. Can get pricey.
Any other major players?
CryptoQuant is another big one, very similar to Glassnode in its offerings. Powerful on-chain insights.
What about something more budget-friendly for starters?
Into the Block is a good option there. More accessible, user-friendly. A great way to dip your toes into on-chain data without the bigger commitment.
Okay. And beyond data platforms, communities, where do people talk about this stuff?
Social media is huge. Reddit has massive crypto communities. Our cryptocurrency, our crypto moonshots for finding potential new coins, our Bitcoin beginners.
Developers sometimes hang out there too?
Yeah, sometimes. And the Upflow system can help filter good content. Just be aware, most of the deep discussion is in English.
What about Discord?
Discord is massive for crypto. Functions like a social hub with voice and text channels, lots of specialized servers, crypto commanders, crypto peers, elite crypto signals, huge interaction potential.
And the fast-paced ones, Twitter, Telegram.
Excellent for real-time news, quick updates, project announcements, but you have to be extremely careful.
Scams, bad info.
Rife with them. Always exercise extreme caution. Verify everything independently before acting on anything you see on Twitter or Telegram. Double, triple check your sources.
Sound advice. Wow, okay, we've covered a lot of ground.
We really have.
You've taken us through a pretty comprehensive deep dive into crypto essentials, from the basics of value, buying, selling, storing.
Right, through safe investing principles, different strategies like long-term versus short-term trading.
How to evaluate projects, spot trends, and crucially, where to find trustworthy information.
And the key takeaway is that this isn't just abstract theory. It's really a foundational toolkit. It should give you practical knowledge, actionable insights.
So you can navigate the market more confidently, make informed decisions.
Exactly. You're genuinely better equipped now, hopefully, to see the opportunities and manage the risks in this really dynamic space.
It's constantly changing.
Constantly.
So maybe a final thought to leave people with.
Well, just remember this. The decentralized world of crypto.
Yeah.
It's still being shaped, not just by big institutions, but by the collective innovation. The choices, the curiosity of individuals just like you.
So the question is,
what will you choose to explore or build or discover next in this fascinating, always evolving landscape?